So far, the backdrop for emerging markets looks positive in 2018. Global growth continues to improve, the US dollar looks contained, and investor risk appetite has held up well. EM corporate fundamentals are improving, with double-digit growth in cash flow measures driving stronger balance sheets. But an upswing in growth-related capital expenditures could slow ratings upgrades this year. Overall, I still see attractive valuations in emerging markets relative to developed markets. However, with the outperformance we saw across EM in 2017, we are looking more closely for differentiation. The commodity improvement story may have played out, and we are now focusing more on industrials and consumer plays which have benefited from growth tailwinds.
2017 could generally be called a coupon clipping year for the bank loan market. Most of the market was priced above par, so price appreciation was fairly limited. We expect similar returns in 2018. Corporate fundamentals are holding up overall, and defaults are likely to remain below historical averages. CLOs and retail investors could also support the loan market this year. CLO issuance forecasts for 2018 are very robust, and we believe retail investors could add to their bank loan allocations as the Fed continues to raise rates.
The race is on among major global auto manufacturers to develop electric vehicles that will be on the road beginning early next decade. The challenge for electric vehicles is price. They will need to fall more in line with cars and trucks currently equipped with the traditional internal combustion engine. Driver anxiety regarding electric vehicle range is another hurdle, one that will probably stick around until charging stations become more widely available.
US banks have had a good year, helped by lighter regulation and a Goldilocks economy that is not too hot, not too cold. In my view, the outlook for 2018 is for warmer porridge, in the form of a strong economy and easing of bank regulations. But watch out for the three bears. The first is inflation spike, in which case the porridge gets too hot. The second is trade war, in which case the porridge gets too cold. And the third is North Korean conflict, in which case the porridge gets vaporized. Any of these bears could chase Goldilocks away.
We have several high-stakes elections taking place in Latin America this year, in Mexico, Brazil, and Colombia. In Mexico, we have a controversial populist candidate, Andrés Manuel López Obrador, also known as AMLO. In Brazil, we're contending with the possible return of Lula, who was sentenced to 12 years in prison on corruption charges. And they have yet another leading candidate, Jair Bolsonaro, whose policies and persona are reminiscent of the Philippines' President Duterte. In Colombia's election, it's wide open, so voters could be in for a surprise.
Inflation eluded investors last year. Now that the output gap is presumed to be closed, the big question for investors in 2018 is, will US inflation finally accelerate and exceed expectations? This could have huge implications for Fed policy, global bond markets, and all asset classes that have benefited from the ultra-low interest rate environment of the past 10 years. Considering the recent passage of tax stimulus in the US at a time of full employment, plus the large numbers of cities and states with rising minimum wage levels this year, we expect strong consumption and potentially also strong corporate investment to drive the prices of goods and services higher. Hence, we think inflation could be a much more critical issue for investors in 2018 than it has been in recent years.
The value of the US dollar is a major influence on world trade and the outlook for emerging markets. The 2017 recovery in world trade growth coincided with a weaker dollar. The reason is simple. A weak dollar improves the purchasing power of the rest of the world, especially emerging economies, which contribute nearly 80% of global GDP growth. If the dollar exchange rate remains in a stable range or depreciates further, emerging markets will likely have another good year in 2018.
After several years of muted loan growth rates, U.S. banks are hopeful that tax reform will spark commercial customers to borrow to expand their operations. This, along with the interest rate increase in December, should provide a boost to net interest margins and net interest income in 2018. In addition, I'm looking forward to increased use of technology by banks, including artificial intelligence, in their back-office operations. Technology combined with other expense savings initiatives should improve efficiency.
I think S&P 500 operating earnings growth could approach double digits in 2018, and U.S. tax reform is poised to provide an additional one-time boost. If global growth continues at its current pace, 2019 could be another year of healthy growth too. But keep in mind, bull markets don't die of old age, and any adverse economic shocks or policy errors could cloud a rosy outlook.
The healthcare space continues to evolve rapidly, and some companies cannot keep up. State and federal legislative changes, new consumer behavior, and technological developments are threatening traditionally safe profit pools. Distribution will be an important area to watch, and I think the internet will incrementally impact healthcare just as it changed the game in consumer products. As healthcare brands retain less and less control over distribution, they are at greater risk of being undercut by online discount sellers. Companies with great leadership, strong brands, and thoughtful distribution strategies will likely win.
As we think about portfolio strategy here at the beginning of this year, one of the most important factors that we are considering is the fact that the world economy is speeding up. The U.S. economy has been growing at 3% and may grow even faster than that as we look at the possible consequences of the most recent tax cuts. Around the world, the rest of the world economy is growing at something like 4%. The result of that is that earnings expectations everywhere are increasing. This is a wonderful background for equity markets. In turn, that kind of growth and that kind of confidence and optimism will only encourage the Federal Reserve to feel comfortable in raising interest rates at least twice more between now and the beginning of the year. With that kind of background, it may seem curious that the US dollar is actually weakening, but we do not think that is a market reflection on an adverse view of the US economy. We think that's a market view of confidence that other opportunities around the world are even more attractive.